Good day, Junior Tickies. I'm Mrs. Brimacone. We're going to focus in this video a little bit on the theory. Now, when you've done activity one, the focus was on a perpetual or continuous inventory system. So basically, it's work that you've covered in grade 10. If we just go back and what have we've done, if you look at this type of system, all movement of trading stock is recorded. If you look at the first one, we started with 2 items, then more were purchased. So now it means currently we've got an idea about what is our total purchases. This is the number that we sold, so we know exactly how much is left over. Again, this is because all movement of trading stock is recorded in the trading stock account. We show when items are sold. If we look at the difference between the two systems, and this is very important to understand, with a perpetual or continuous inventory system, inventory quantities are updated after each transaction. We know exactly how many items were sold. We know exactly how many items are left over. Whereas if we're looking at a periodic inventory system, inventory quantities are updated at the end of the period, taking physical inventory count. So we have to literally take a physical stock count to see how much do we have left over. We do not track exactly how many items were sold. We do not know how many items are left until we count the closing inventory. So this is the difference between the two systems. Now, when we're looking at inventories, this forms part of your paper 2, the periodic and perpetual inventory systems, concepts, recording, and control. So your typical type of questions which you can expect is calculating cost of sales, calculating the gross profit, prepare the trading account. You will get problem-solving types of questions. Calculate the stock holding period, the stock turnover rate, calculating how have we achieved our end markup. So looking at these, we're looking at financial indicators. What is the difference between a periodic and a perpetual inventory system? Now, these are just an idea of the types of questions that you can expect when we're looking at inventories. What is very important to understand is the concepts. Make sure that you know what is your opening stock. When we're talking about our opening stock, it is unsold stock from the previous financial year. It's the stock balance in the beginning of the financial year. Opening stock is an expense to the business when we're using a periodic inventory system. When we're looking at the purchase of stock, it's stock bought during the year. Stock can be purchased cash or on credit. It's regarded as an expense. Now, any other cost in getting the trading stock, we need to open an expense account for that. When we're looking at transporting goods, getting that goods to us, it means carriage on purchases. That is an expense to the business. Do not confuse carriage on purchases with carriage on sales. Carriage on sales is deliveries to customers. It's also an expense to the business, but it has nothing to do with calculating the cost of sales. This is regarded as an expense which will appear in your profit and loss account. Remember, it's deliveries to customers. Returns of stock, if stock is sent back to our suppliers, it will decrease my expense, which means in a periodic inventory system, the purchase account will decrease. Closing stock is what we have physically counted, what is left over at the end of the accounting period. In a periodic system, we're still going to have the trading stock account, but the only thing that will appear in there is my opening stock and my closing stock. If we look now at the ledger accounts, as I've just mentioned, in my trading stock, it is a current asset. The opening balance, the balance in the beginning, is going to be taken to your opening stock, which is an expense to the business. The end of the accounting period, we do a physical stock count. That is called your closing stock. If we look now at all the expenses, trading stock, nothing is recorded in the trading stock account except opening stock and closing stock. So it means when we're buying trading stock, cash or credit, that goes to the purchase account. When stock is donated, when stock is taken for personal use, any movement with regards to our trading stock will now go into the purchase account. If we have to pay for transport, cash or credit, it means we now need to open up an expense account, which is carriage on purchase. If we have to pay for import duties in getting that trading stock, before it would have been added to the trading stock account if we use a perpetual or continuous inventory system. But now we need to open an expense account, import duties, and it will be the same for any other cost, like custom duties, freight, harbor dues, any other cost. Now these are all expense accounts, and you've learned in the nominal account section, the end of the accounting period, everything is closed off. This is an expense, but it does not form part of your operating expenses. This will always be closed off to your trading account. So you can study in your trading account. We would always have sales. But the first closing transfer, debtors allowances, is closed off to sales. We would always have our opening stock plus purchases plus carriage on purchases plus any other additional cost like custom duty minus the closing stock. And there's a particular reason why I've mentioned it in this way now. This is how we calculate our cost of sales. You need to know how to calculate your cost of sales using this format, this calculation, and by calculating it from the trading account. From the trading account, cost of sales can also be calculated by taking your sales minus the gross profit equals cost of sales. Take note, it will give you exactly the same answer. So to calculate your cost of sales, it's always your opening stock plus purchases plus carriage on purchases plus any other additional cost equals cost of stock available for sale minus your closing stock equals your cost of sales. Refer now to activity 1, which we've completed. This is just to give you an illustration of what will happen. Every single time when stock was purchased cash or on credit, we would have shown it in our trading stock account. Now, the trading stock account will be replaced by the purchase account. If we needed to pay for transport in getting that trading stock from the suppliers to us, it means that trading stock will now be replaced by carriage on purchase. If we are selling goods, if customers returns goods to us, there's no cost of sales. So now you can leave it out. Learners tend to in grade 8 and 9, or grade 9 specifically, when we first start with these transactions. They always forget the cost of sales. Now in a periodic inventory system, you may leave out the cost of sales. Cost of sales is only calculated at the end. What I've mentioned just a minute ago, to calculate your cost of sales, opening stock plus purchases plus carriage on purchases plus any other additional cost equals cost of stock available for sale minus your closing stock equals cost of sales. Another way in calculating it from your trading account, take the sales minus the gross profit. So make sure that you understand the difference between the two inventory systems. And this is so important because in grade 12, we're also doing inventory systems. But then we're adding to that. Within these two systems, there's different ways in which we evaluate our stock. So the foundation is now laid in grade 11. Again, make sure that you understand the difference between the two inventory systems. From activity 2 onwards, we are going to look at only periodic inventory system, and you will see the last activity, we are going to look at problem solving types of questions. You need to make sure that you practice those type of questions, because that is what you can expect in paper 2. Hope you have a wonderful day.